Hi everyone, good morning. Welcome once again to our channel, and we are going to again do one more marathon for another sub chapter in corporate and management account subject, part B. Okay, this is your module 2, paper 5. So what am I going to do today is very important for you all to understand. I am going to do chapter number 16, which is ratio analysis. Okay, ratio analysis has always been a very important chapter in management accounts. Okay, it falls in management account section. So today I'm going to do ratio analysis with all the formulas. I'm going to do some practice sums, and then later on I will be going to the exam questions. Okay, so this will be basically our our agenda today is to know all the formulas which are following, how to find the ratios, okay, what all has to be done to arrive from given ratio to arrive a given amount. So we will do some practice sums based on that, and then we will go to the past exam questions. Okay, so now let's begin ratio analysis. Okay, now before I start with the formula, just to make you all understand that ratio analysis, it is very important, okay, for the management of a given company. Management, key managerial personnel, the ones who are in managerial positions, okay, they are the one who make strategic decisions, long term decisions. Strategic decisions of an organization are taken by them. So basically their long term plannings are done for the benefit and the growth of a given organization, right? So on what basis will the management take these decisions? Okay, they will obviously need a few ratios. Okay, they all know their balance sheet, they all know their profit and loss account, but they're not concerned with the balance sheets and P&L accounts. Okay, it is their own company. They need the ratios. They are more concerned कि भाई, what was the net profit margin? What was gross profit margin in 2020 as compared to 2022? What is our capital employed? What is the rate of return we are providing on capital employed? Okay, comparing that with the past years. Okay, how much is the earning per share? Correct. So these are like the type. What is the gross profit percentage? How much is the debtors turnover ratio? How much is the credit sales which I am generating? And what is the debtors collection period, how many days I'm getting, what is an average period in which I'm able to collect the debtors amount. Okay, so this is all in the form of the report. Okay, so ratio analysis is a part of the management, that is why it falls under the management accounting head. Okay, cost and management is a part B, right? So in management accounts we follow and we do ratios. Ratios are calculated with the help of that particular balance sheet and profit and loss statement. Okay, so now we have many ratios. I have made a list of it. Okay, there are ratios which is known as part A. If you see ratios which are known as profit margin ratio, they can also be known as sales ratio, because all this for calculating this particular ratio we need the sales amount. Okay, so if I am asking you what is the gross profit margin, it will be nothing but gross profit upon sales into 100 in form of percentage. If it is asked what is the net profit margin is always calculated on sales. They are all profit margin ratios. Okay, so net profit upon sales into 100. How much is the operating expenses? Okay, in a given business there can be operating expenses, there can be other financial expenses, investment expenses, there can be different types of expenses. But operation expenses if I'm concerned with, and I want to find the margin of that how much is the operating expenses to my sales. It will be operating expenses upon sales into 100. And what will be the operating ratio? Operating ratio will include both. It will include operating expenses plus the cost of goods sold which we do in trading account. upon sales into 100. So operating expense ratio is different, operating ratio is different. Okay, I have listed all the formulas for your better understanding. Okay, so whenever we are solving a given sum, we can just refer to this particular formula and go back and solve the sum quickly. Alright, so gross profit, net profit ratios, the higher the ratios, they are better. But if I am talking about the expenses ratio, lower is the better, obviously. Okay, so what decisions are taken, what understanding is done with the help of the ratio is this. Okay, analyzing the ratios. Moving to the next one is capital ratios. So if I talk about return on capital employed, or if I talk about return on investments. Okay, return on capital employed or return on investments, generally we do net profit before interest and tax upon capital employed into 100. Sometimes we also take net profit after tax. Okay, depending on what is asked in the question. But return on capital employed, generally net profit, NPBIT. We have done the statements. If you will refer to all my previous revision lectures, we have always keep talking about NPBIT. It is net profit before interest and tax. What interest? Before long-term and short-term borrowing interest. And what is our capital employed? It is our shareholders' funds plus our borrowed funds. So by now you should all be familiar with all these terminologies, okay, with all these terms, all the concepts, okay. Return on the shareholders' funds is also known as return on net worth. This is specifically done on net profit after tax upon the shareholders' funds only. Shareholders' funds, return on net worth or return on shareholders' funds into 100. Therefore, net profit upon shareholders' fund into 100, that will come in form of percentage. And if I am talking about only return for equity, so net profit available for equity shareholders upon equity shareholders funds into 100, that will give me my percentage. Okay, that net profit is obviously net profit after tax. Net profit available for equity shareholders. We all know what is that. After deducting everything, after tax, after preference dividend. Okay, so all that once we deduct, we come to net profit available for equity shareholders. Return on total assets. Again, I'm talking about return. I'm talking about capital ratios. Okay, so return on total assets is again nothing but NPBIT, net profit before interest and tax, upon total assets into 100 in the form of percentage. All these ratios, profit margin ratio and capital related ratios, were in form of percentage. Okay. So just to give you a specimen, we first have a gross profit which we have arrived from the trading account, sales, opening stock, purchases, direct expenses. Okay, we arrive at gross profit. With the help of gross profit, I will less my operating expenses. I can add my sum of the operating income. I will arrive at net profit before interest and tax. From that, I am supposed to subtract interest on short-term borrowings. Say example, there is an OD, overdraft facility. Then interest on long-term borrowings, I will arrive at net profit before tax. Tax rate will be given, net profit after tax. From there, I will subtract my preference dividend. Net profit available for equity shareholders. If I will subtract my equity dividend also from it, say suppose tomorrow I am paying them equity dividend. So if I subtract my equity dividend also, then I will transfer whatever is available to P&L account or a reserve account, etc. But generally, companies have a practice of transferring some amount to reserves first and then declaring the dividend. But any one of the thing can be done. Okay. So whatever is left after the equity dividend is then transferred to the profit and loss account. Okay. To the reserves account. Now very important again, liquidity ratios. Liquidity, short-term ratios. How liquid is the firm? How quickly they can, how quickly can they pay their current liabilities? Is the current assets able to absorb the current liabilities, the amount which we receive from the assets? Okay, so these are known as liquidity ratios. So first important, current ratio. Current assets upon current liabilities, the standard is 2:1. That means current assets should be 2 and liability should be 1. Then you are standing at a standard. Okay. Liquid ratio is known as quick ratio. It is also known as acid test ratio. Acid test ratio. So current assets minus stock minus prepaid expenses will give you your liquid assets upon liquid liabilities. What are liquid liabilities? Liquid liabilities is nothing but current liabilities minus bank OD. And what is liquid assets? Liquid assets is nothing but from the current assets you subtract your stock. Stock is not a liquid asset. It will take time for you to sell it. Prepaid expenses, fictitious assets. Preliminary expenses, fictitious assets. Okay, they are not going to help me in my liquidity, right? Similarly, current liabilities, quick ratio, liquid liabilities, remove bank OD from the current liabilities, and that you will get the liquid liabilities. So liquid assets upon liquid liabilities, generally bank OD is never given, okay, in the sum. So it always stays as current asset minus stock minus prepaid expenses upon current liabilities, if nothing is mentioned. Then we have absolute cash ratio. How much cash do we have to pay our current liabilities? So we have our cash. Then there can be cash equivalents, cash in the bank, etc. Okay, so cash and cash equivalents plus any kind of short-term investment which can be converted into cash within 1 or 2 days. Short-term investments upon current liabilities. Absolute cash ratio. And the fourth one is defense interval ratio. What is defense interval ratio? It is nothing but the same thing. How much cash you are having over daily operating expenses. Okay. So in how many number of days are you able to pay your daily operating expenses with the cash you have? Okay. So defense interval ratio. How you are able to pay your operating expenses in how many days? Okay, with the amount of cash and cash equivalents which you have at your disposal. Okay, so say I am taking 40 days or 90 days, etc. It will be in form of days. We will practice all the formulas. Okay. Coming to stability ratio. So we did liquidity ratio. Now coming to stability ratio. It is also known as long-term ratio. Liquid ratios were known as short-term ratios. So long-term ratio 1 we have debt equity. Okay, very famous debt equity. Borrowed funds upon shareholders funds. Standard should be 2:1. Okay, not more than that. Right? Capital gearing ratio. Fixed return bearing securities. Fixed return bearing securities means on uh, those funds in which you have to compulsorily pay either interest or dividend. So there are only two types, no? One is borrowed funds on which you pay interest, loan, debentures, and one is preference share capital. Okay, they are fixed return bearing securities. Divide by securities not having fixed return. Which are those securities? All the type of shareholders funds apart from preference share capital. So all the type of equity share capital, reserves and surplus, etc. Not necessary we have to pay them a fixed return. Equity shareholders is nothing is fixed. It depends upon the profit. Every year there is a resolution passed to give the equity dividend. They do not have a fixed percentage of dividend like preference share holders. Okay. So borrowed funds plus preference share capital divided by shareholders funds minus preference share capital. This is how the formula is. And the fourth one is the proprietary ratio. Proprietary ratio is nothing but shareholders funds upon total assets. Whatever funds are there. Okay, whenever we borrow funds, that has to have a corresponding assets, right? So the shareholders funds divided by total assets into 100. Standard is 60 to 70% or more than that is better. Not less than that. Okay. Moving to turnover ratios. Easy ones. Turnover ratios. If I tell you turnover means sales. Okay. Just one word understand. Turnover means sales. So if I tell you capital turnover ratio, it is nothing but sales upon capital employed. It will come in times. All these ratios now will be in times. Total asset turnover ratio again same. Sales upon total assets. in ratio will be in times. Fixed asset turnover ratio, it's very easy to remember these. Sales upon fixed assets. Debtors turnover ratio will be credit sales. I will generate debtors only if there is a credit sales. Now, if there is cash sales, there is no debtors. So, credit sales upon average of debtors plus bills receivable. You take average of both, opening debtors plus closing, average of bills receivable also. Opening, closing, divide by 2. Okay. Stock turnover ratio on cost of sales upon average stock. Okay. Stock turnover ratio, cost of sales. Cost of goods sold, COGS generally. Okay. Then we have creditors turnover ratio. Obviously, if we have done credit purchase, then only we will have creditors, no? So, credit purchases upon same thing. For debtors turnover, it was credit sales upon average debtors plus bills receivable. Here, it will be credit purchases divided by average creditors plus bills payable. Debtors velocity ratio, or you can say debtors collection period, in how many days, approximately I am getting, paid by my debtors. So your average debtors, now you will just, kind of reverse the debtors turnover ratio. It will be average debtors plus bills receivable divided by credit sale into, if it is into months, for months, if you have to calculate in form of months, then into 12, in form of weeks, then 52, and in form of days, 365. Stock velocity ratio or stock holding period. For how many days am I holding the stock before it is selling? Okay. So, average stock upon cost of goods sold. Just reverse the stock turnover ratio. Okay, reverse the stock turnover ratio over here. Again, same 12, 52, 365. And creditors payment period or creditors velocity ratio is average of creditors plus bills payable upon credit purchases into 12 or 52 or 365. The higher I am getting creditors payment period, the better, obviously, for me as a company. But for debtors velocity, lower the better. Stock holding period, lower the better. That means I am able to sell my stock fast. Correct? Then we have market test ratios and investor point of view. Okay, ratio. So if I want to know my earning per share, I will take the net profit of the available for the shareholders, for the equity shareholders, upon total number of shares. Dividend per share, if I want to find, then total dividend for the equity shareholders upon total number of shares. We all know dividend payout ratio. So here dividend payout ratio will be total dividend, okay, for shareholders upon net profit for shareholders into 100. So if I have to find dividend payout ratio, then I will take the amount of total dividend, divide that by the net profit for shareholders. Then we have price earning ratio. Price earning ratio is nothing but market price per share upon earning per share. Lower the better. Obviously, price earning ratio should be lower. Why? That means I am able to reach to the market price quickly with the earning per share I am getting. Okay. Then we have yield ratio. Dividend yield ratio. Dividend per share upon market price per share. Higher the better. Earning yield ratio, earning per share upon market price per share, again higher the better. Okay, so all these formulas. Now we have a specimen format of NPBIT minus interest, net profit before tax, minus tax, net profit after tax, minus preference dividend, net profit for equity shareholders, minus equity dividend. I just showed you all this particular format. Net profit transferred to P&L. Then some of the other formulas. Sales is what? Cost plus gross profit. So cost of goods sold plus gross profit. Working capital is nothing but current assets minus current liabilities. However, whenever there is no borrowed funds in the organization, borrowed funds is zero, then your working capital, this is a formula. Okay, only when the borrowed funds is zero, in that case, your working capital can also be calculated with the help of shareholders' funds minus fixed assets. Okay, only when the borrowed funds are zero. Then you have average stock. Opening stock plus closing stock divide by 2. If I tell you to find average debtors, opening debtors plus closing debtors divide by 2. Cost of goods sold, opening stock plus purchases minus closing stock. And net worth means the shareholders' funds. Okay. Now there are certain coverage ratios, last part of it, of the ratios. Interest coverage ratio. How much is the net profit before interest and tax to cover my interest? Dash times. Preference dividend ratio. How much is my net profit after tax to cover my preference dividend? Equity dividend coverage ratio. Net profit available for equity shareholders upon equity dividend. Dash times. Total dividend coverage ratio will be now net profit after tax plus equity dividend plus preference dividend. And debt interest service coverage ratio is nothing but your net profit before interest and tax plus depreciation minus tax, or else you can just take net profit. Okay, but you have to take it like this. So net profit before interest, I'm talking about debt interest service coverage ratio. So from that, first I will add back my depreciation, non-cash expense, minus my tax, and upon that I will divide that by interest I have to pay on my debt plus the installments I am paying on my principal. So generally EMI. EMI includes both installment of principal plus the interest factor. Okay, so debt interest service coverage ratio. Okay, these are not asked very often, but yes, we have to know the formulas in case if somebody, sometimes in some paper there is always a surprise element, as I always tell you. Okay, so these are the formulas. You have to remember the formulas, kind of understand the formula, it will become very easy to remember. Okay, do not mug it up. Do not cramp yourself of just learning all the formulas. It will never happen. Okay, so we have done profit margin ratios, we have done capital ratios, we did liquidity ratios, which is known as short term, then we did long term ratios known as stability ratios, we did all the turnover ratios, market test ratio, investors ratios based on earning yield, market share, etc. Then we have done certain formulas based on our trading account. Coverage ratios was the last one. Okay, now I am moving to some practice questions. Okay. Alright. Chapter 16, ratio analysis. Let's read the question first. The following data of Vishal Limited is available for the year ended 31st of March 2007. Share capital rupees in lakhs. Share capital 20 lakh, equity shares of rupees 10 each, 200. General reserve 150 lakhs. Investment allowance reserve 50 lakhs. Provision for dividend 10 lakhs. Provision for taxes 84. 15% long-term loan 300 lakhs and profit before taxes 140 lakhs. We have to calculate capital return employed, return on capital employed. Basically, they are saying return on capital employed, and we have to calculate return on net worth. Okay. So to make it easy, I am first writing down the formula. Okay. Solution 1. Return on capital employed, I have told you it is NPBIT upon capital employed into 100. And return on net worth is nothing but net profit after tax upon shareholders' funds into 100. Now I need all these values, NPBIT, capital employed, net profit after tax, shareholders' funds. All this I need. So how will I get it? I have done a working note. They have given me interest. They have given me profit before tax. Tax provision here there is 84. Okay, so if I take tax given 84, okay, and tax profit before tax which is given 140. 140 minus 84, I'll get net profit after tax. But I also need my NPBIT. So if I will add my interest to NPBT, if I will add this, when I'm going reverse, I will add. I'll get NPBIT. I know my interest. How I know it? It is 15% on 300. Okay, so 15% on 300 is 45. So to 140, if I add 45, if I'm going reverse, it will come to 185. So I have my NPBIT. I also have my net profit after tax. Now I need my shareholders funds and capital employed. So what is my shareholders funds? Shareholders funds is nothing but share capital plus reserve and surplus. So my share capital is 200. General reserve is 150 and investment allowance reserve. So there are three things. Okay, I'm adding that. 200 plus 150 plus 50, 400. Capital employed will be what? Shareholders funds, which I already found, plus my borrowed funds, which is given. Borrowed funds is 300. Therefore, my capital employed will be 700. So putting them in the formula, NPBIT 185 upon capital employed 700, percentage is 26.43, and net profit after tax is 56, shareholders funds is 400. My return on net worth is 14%. So all your answers are within the question only. Provided you know the formula, you will be able to find it. Okay. Now moving to the next question. We have to find the absolute cash ratio and defense interval ratio from the following data. Okay. So cash and bank balance, current liabilities, investments which are marketable. Those which are marketable means they are short term. Non-marketable means they are long term investments. Operating expenses for the entire year, including depreciation, is 83,000. Both types of investment, if sold today, will fetch twice of its value. Okay, fine. So first I'm writing the formula. What is absolute cash ratio? I told you cash plus cash equivalents plus short-term investment divide by current liabilities. Okay, I know my cash. It is given to me 10,000 here. Current liabilities also I know 20,000. So divide by 20,000 I know. Cash and cash equivalent is 10,000. Short-term investment is only 5,000. But they can fetch me, if sold today, twice of its value. So I will take 10,000. 5,000 into 2. Divide by 20. So my absolute cash ratio is 1:1. Defense interval ratio. Same thing. Cash plus cash equivalent plus short-term investments upon daily operating expense. Now I do not know my daily operating expense, so I have done a working note. Daily operating expenses means yearly cash expenses, cash operating expenses. They have given me 83,000, but that is including depreciation. Depreciation is a non-cash expense. I will remove that. 73,000 divide by 365. I want daily. Daily, each day, how much is my operating expense? So rupees 200 per day. So how much cash and cash equivalent I have? Okay, over my daily operating expenses, 100 days. Okay, is the answer. Right? Now moving to the next question. Anjali Limited has provided the following balance sheet as on 31st of March 2008. Share capital 5 lakhs, fixed liabilities and current liabilities. So total is 10 lakhs. Here, total is 10 lakhs. Okay. Assets, we have fixed assets, liquid assets, stock in trade. Again, total is 10 lakhs. You are required to compute the following test ratios: long-term solvency of the company and short-term solvency. Fine. Long-term solvency, I will be able to calculate my debt equity ratio. I'll also be able to do my proprietary ratio. Debt equity ratio is nothing but borrowed funds upon shareholders' funds. Everything is given to me. Borrowed funds. Okay. Share capital, fixed liabilities and current liabilities. Borrowed funds is nothing but 2,50,000. Fixed liability which is given. Fixed liabilities, borrowed funds. This is my shareholders funds. So 0.5 is to 1. Standard is 2 is to 1. Proprietary ratio. So standard is 2 is to 1 and they have 0.5 is to 1. So tomorrow if they need more funds, they can go ahead and take it in the form of debt. Okay, they have not crossed the standards yet. Proprietary ratio will be shareholders funds upon total assets. How much is the total assets? Total asset side. Everything, fixed assets, liquid assets, stock, etc. Everything. So my total assets is 10 lakhs. Shareholders funds is 5 lakhs. Therefore 50% is my proprietary ratio, which is less than the standard. They should see to it that they can increase it. Okay. Short-term solvency. Current ratio and liquid ratio I can find. Yeah, with the help of all the details given. Current ratio is current assets upon current liabilities. Both is given to me. Okay, I have been given liquid assets and stock in trade. So if I will add this two, it will become current assets. Current assets will be 4 lakhs. Current liabilities is given to me as 2,50,000. So my current ratio is 1.6 is to 1. Liquid ratio will be current assets minus stock minus prepaid expenses. So liquid assets is already in fact given to me. You don't even need to do that. Liquid assets will stay as 3 lakhs and current liabilities only. There is nothing like bank OD or something. So divide that by current liabilities. So this is liquid assets upon current liabilities for this particular sum. Right? There is no bank OD, no? And liquid assets they have already given me in my sum also. So here 1.2 is to 1. Okay. Moving to the next question, number 4. From the following information now ascertain. Now they have given me the ratios. Okay, and they are telling me ascertain how much is the long-term loan, what is the amount of reserves and surplus, what is the amount of capital employed. They have given me capital gearing ratio, debt equity ratio, equity share capital and preference share capital. This is the details they have given me. Okay. Now capital gearing ratio, the ratio which they have given me 0.75. The formula for it is preference share capital plus borrowed funds upon shareholders funds minus preference share capital, which is 0.75. Okay. They have given me one debt equity ratio. Debt equity ratio is borrowed funds upon shareholders funds. Means what? Debt equity ratio is 0.4 they have provided to me. That is equal to borrowed funds upon shareholders funds. Therefore, I have written borrowed funds is equal to 0.4 of shareholders funds. That particular ratio of borrowed funds to shareholders funds I have put in my capital gearing ratio. Why? Because the preference share capital amount I have. Okay. Instead of borrowed funds, I am putting 0.40 of shareholders funds. Divide by shareholders funds I have to find. They have given me equity share capital and preference share capital. They have not given me shareholders funds. Okay. So with the help of that particular equation, I'm trying to create an equation. Shareholders fund minus 1 lakh is equal to 0.75. Now this 0.75 I am multiplying it with shareholders funds minus 1 lakh. That will give me 1 lakh plus 0.4 shareholders funds. When I solve this equation, my shareholders funds comes to 5 lakh rupees. Now with the help of this shareholders funds, I can put it in the formula, no? Borrowed funds is equal to 0.4 of shareholders funds. Therefore, borrowed funds will now be 2 lakhs. Shareholders funds is 5 lakhs. Shareholders funds includes both equity share capital plus reserves and surplus plus preference share capital. So, equity and preference is given to me. Shareholders funds is what I have found. So, reserves and surplus will now be 1 lakh rupees. And capital employed is shareholders funds. We already found that. Plus borrowed funds, what all again we found that. So capital employed is 7 lakhs. Okay, so when you will be able to solve a sum, understand the question properly for ratio analysis. Okay, and then try to put that formula, and based on that you will be able to arrive from one answer to another. Okay. And all the exam questions are also pretty similar to this only. Now question number 5. From the following balance sheet, you are required to calculate quick ratio, current ratio, quick ratio, inventory turnover, average collection period, presuming 360 days in a year, and own funds to liability ratio. Okay. Sales for the year, credit sales for the year is 4 lakhs, and then I have gross profit is 1,60,000. Okay. So now they have given me my share capital, reserve surplus, debtors, creditors, bills payable, other current liabilities, assets I have goodwill, plant, stock, debtors, cash, and miscellaneous current assets. Okay. First ratio is current ratio. Current ratio will be upon current assets upon current liabilities. How much is my current assets? Current assets will be nothing but 80,000. Stock is my current assets. Debtors is my current assets. Cash is my current assets, and other current miscellaneous current assets. Goodwill and plant and machinery are not my current assets. Okay, so I have to add all this. 80 plus 45,000 plus 17,000 plus 8,000. 1,50,000 is my current assets. And my current liabilities will be creditors, bills payable, and other current liabilities. Okay, so it will be 62,000. So current assets to current liabilities is 2.42. Quick ratio will now be current assets. From there I will subtract stock and prepaid expenses. Prepaid expenses, so I don't have, only the 0. Upon current liabilities minus bank OD. So I don't have bank OD also, it is 0. So basically it is current assets minus stock upon current liabilities. So if I will remove stock from my 1,50,000, I'll get 70. Divide by current liabilities, 1.13 will be my ratio. Inventory turnover ratio is cost of goods sold upon average stock. How much is my cost of goods sold? When they have given me sales and they have given me profit, so my cost of goods sold will be how much? Obviously the balance, right? Sales is equal to gross profit, no, plus COGS, right? So they have given me sales. Sales is how much? 4 lakhs. They have also given me my gross profit as 1,60,000. So I can easily find my COGS. COGS will be 4 lakh minus 1,60,000. This will be 3 times. Debtors collection period, average debtors plus bills receivable upon credit sales into 12, 52 or 365. But here in the sum they have told me to take 360, so I am taking 360. My average debtors, I do not have anything as average debtors. Opening closing is not given. So then I will take this only debtors amount, 45,000. Upon credit sale already given to me into 360, 41 days approximately. So I am getting paid from my debtors in every 41 days. Own funds to liability ratio. Now there is no such ratio, but they are telling me own funds to liability. So I have made this. Own funds means shareholders funds upon total liabilities. How much is my shareholders funds? 2 lakh plus 58,000. Divide by total liabilities. 1 lakh plus 40 plus 20 plus 2. So 4 lakh 20,000 will be my total. No, sorry, my total liabilities. Total of the liability side. Own funds upon total liability. Okay, so there very rare situation they can ask you some ratio which is not the one which is already there in the standard sheet which I just taught you. Okay, not necessary. So there can be some type of this ratio. You can even calculate these ratios. Okay, there is no problem as such. Okay, just give me a minute. Alright. Moving to next question. ABC has made plans for the next year It is estimated the company will employ total assets of rupees 8 lakhs. 50% will be financed by borrowed capital, on which interest rate will be 16% per year. Okay. I hope I am audible to all of you all. So, just reading the question number 6 once again. ABC has made plans for the next year. It is estimated the company will employ total assets of rupees 8 lakhs, from which 50% they will finance with borrowed capital and interest rate on that will be 16% per year. The direct costs for the year are estimated rupees 4,80,000 and all the operating expenses are rupees 80,000. Goods will be sold to the customer at 150% of the direct cost. Income tax rate is 50%. You are required to calculate net profit margin ratio, return on assets, asset turnover and return on owner's equity. Okay. So first thing I have to understand that their plan to employ some total assets is 8 lakhs rupees for the next year, from which they are telling me 50% we will take from borrowed funds. So 4 lakhs from borrowed, on which there will be interest of 16%, and 50% will the balance be shareholders funds. Direct expenses they have given to me is 4,80,000. Sales. They have told me goods will be sold to customers at 150% of the direct costs. Okay, so 4,80,000 into 150% will be 7,20,000. 4,80,000 into 150%. Minus COGS 4,80,000, my gross profit will be 2,40,000. Operating expenses is given. There is no operating income. So net profit before interest and taxes 1,60,000. I know my interest. How? Because 4 lakhs I am borrowing at the rate of 16%. So 64,000. Net profit before tax 96. Tax rate is 50%. So 48,000. Net profit after tax is 48,000. So net profit margin ratio. Net profit after tax upon sales into 100. Okay. So I have taken 48,000 upon 7,20,000 into 100. 6.7%. Net profit margin ratio can also be found on net profit before interest and tax. If you are taking NPBIT upon sales, that also can be done. But generally we take net profit after tax. Okay. Then you have to see your MCQs. Okay, you have to see your MCQs. Net profit margin ratio. Alright. Return on assets. Return on assets is on NPBIT. So NPBIT I have calculated 1,60,000. Total assets I know it is 8 lakh into 100, that will be 20%. Asset turnover ratio, sales upon total assets. Sales is 7,20,000. Total assets is 8 lakh, 0.9 times. And return on equity is net profit available for the equity shareholders upon equity shareholders funds. That is 48,000 upon equity shareholders funds is 4 lakhs into 100, 12%. Okay. So net profit margin is only the thing which, in case you all have a doubt maybe that we are doing from net profit after tax on NPBIT. So in the MCQs try to do both the ones. Okay. Best thing is they will always mention it. Okay. They will provide you with some or the other guidance. But I have done net profit after tax upon sales. So that is also one ratio. NPBIT to sales is also a net profit margin ratio. NPBT upon sales is also a net profit margin ratio. Okay. So I have calculated with net profit after tax. Now moving to the next question. From the following information which is given of ABC Limited, working capital, reserves and surplus, bank OD, fixed asset proprietary ratio, current ratio, liquid ratio. You are supposed to find the amount of current assets, current liabilities and stock. Okay. So first they have given me my current ratio. Current ratio is what? Current assets upon current liabilities. I'll start my sum with a given, no? Something which is given. Current asset ratio is 2.5. That means my current assets is equal to 2.5 of current liabilities. I know my working capital. They have provided me also with my working capital. What is working capital? Current assets minus current liabilities. I know my amount of working capital. I have to just replace my current assets with current liabilities. 2.5 current liabilities minus current liabilities. I will get one unknown variable. Current liabilities 80,000. Therefore, with the help of that, my current assets will be 2.5 of 80,000, 2 lakhs. Right. So, I have found my current liabilities. I have also found my current assets. Okay. Current asset, current liability is done. Fine. Now, I need stock. Now, if I am using my liquid ratio, which they have given me 1.5, liquid ratio means current assets minus stock minus prepaid expense upon current liabilities minus bank OD. In this, some bank OD is there. Okay, so I'll keep it. Prepaid expenses, I will assume it to be 0. 1.5 is my liquid liability. Only stock I don't know. No? So I'll be able to find one unknown variable with the help of this equation. So stock will come to 1,10,000. Okay. So do not panic by reading such big sums. Okay, but they are so simple. Okay, now the next sum. From the information of XYZ Limited, find the following. We have to find the amount of sales, amount of fixed assets, capital employed. We have to find debtors, creditors, purchases, opening and closing stock. They have given me stock turnover ratio, fixed asset turnover ratio, capital turnover ratio. Then they have given me my gross profit margin, debtors collection period 2 months, creditors payment period 73 days, gross profit is 60, closing stock is 5,000 in excess of opening stock. Okay. So let's see. Like this is one all-in-one sum. I am starting with my gross profit margin. Okay. Because I have gross profit also given to me. I have the gross profit margin also given to me. Okay, so if I will start with these two variables, I'll be able to find one unknown variable. What is that? That is sales. Gross profit margin is what? Gross profit upon net sales into 100. So my net sales basically will be gross profit upon that margin. So 60,000 divided by 20,000, I get 3 lakhs rupees as sales. I have my sales. Okay. I have my gross profit. I can find my COGS. Basic, simple. From 3 lakhs, I will subtract my 60,000, which is my gross profit. That will be 2,40,000. This I have just done in case if in any question, in exam question, they tell you that the gross profit is 20% of sales. Your gross profit margin. See, according to my sum, my gross profit margin is 20% of sales. Whenever they give you gross profit as a margin of sales, assume your sales to be 100. Gross profit is 20. Therefore, automatically your COGS will become 80. But if they tell you gross profit margin as a percentage of COGS, then always assume your COGS to be 100. This would become 20 and then now sales will become 120. You will never get a wrong answer. Okay, this is one trick. You will never arrive at a wrong answer. Whatever they are telling you gross profit margin as a percentage of, if they are telling you it is as a percentage of sales, assume sales to be 100. If they are telling you is it is a percentage of COGS, assume COGS to be 100. Okay. This I have just done for your explanation, for your understanding. Okay. There is nothing. You can directly do it from 3 lakhs is my sales minus my gross profit. I will get my COGS. Okay, but if you will do it with this also, your COGS will come to 2,40,000. Okay. Fixed asset turnover ratio means I have got my sales. I have also, they have given me this 4 fixed asset turnover ratio. I am moving to the next ratio. Okay, this one. 4. I have my sales. I will get my fixed assets. Fixed assets is 70. Similarly, they have given me my capital turnover ratio. I can use this. I have my sales. I have my ratio. So my capital employed will be 1,50,000. So I am done with the finding with the amount of sales 3 lakhs. I'm done with finding of amount of my fixed assets was how much? 75,000. And my capital employed is now 1,50,000. Right? All this 3 is done. I have to now find debtors, creditors, purchases, opening and closing. Okay. So for debtors collection period ratio they have given. That is 2 months. Okay. 2 months. So debtors collection period formula is what? Average debtors upon credit sales. Since they have given me in 2 months, I have multiplied that by 12. Okay. So debtors collection period is 2. So debtors will now be how much? If I will I have to find my debtors, I will multiply 2 by 3 lakhs, divide by 12, 50,000. Average debtors or debtors, one and the same thing for this sum. Okay. So my debtors will now be 50,000. Similarly, I will have to do my creditors payment period. But for that, I will need my purchases. So first I will find my purchases. COGS is opening plus purchases minus closing. COGS I know. I do not know my opening stock. I do not know my closing stock. And I even don't know my purchases. So how do I find? Okay. Let the opening stock be X. Let opening stock be X. See why? In the question it is given me. Closing stock is 5,000 in excess of opening. So if opening is X, closing will be X plus 5,000. So I'm just putting this in the formula. 2,40,000 is equal to X. Purchases I don't know. Minus closing stock is X plus 5,000. When I will open this bracket, plus X minus X will get cancelled. This will be minus 5,000. When it will go to the other side, it will become plus 5,000. So purchases will now be 2,45,000. That purchases I will take it in my creditors payment period. Okay, which they have given me 73 days. Creditors will be one which I have to find. Purchases I have found out 2,45,000 into 365. So what I will do for creditors, 73 into 2,45,000 divided by 365. Okay, 73 into, in case you all want to write in detail everything, upon 365. That will be giving me my amount of creditors. Okay, so creditors is now, debtors is how much? We found out debtors 50 and creditors is 49. So debtors is 50,000 and creditors is 49,000. Purchases is 2,45,000. Now I need to know my opening stock and closing stock. So all the other ratios I have used. Okay. Now I will use my stock turnover ratio. Stock turnover ratio is what? COGS upon average stock. They have given me my stock turnover ratio 6. Average stock I need to find. COGS also I know. So my average stock will become how much? 40,000. Average means what? Opening plus closing upon 2. I have already done that. No, X plus 5,000. Opening is X and closing is X plus 5,000 divided by 2. Right. So here this 2 I am taking it, the average stock is how much? 40. So average stock into 2 minus 5,000. When you bring this 5,000 on the other side, you will get is equal to 2x. X plus X is 2x. Divide that by 2, you will get X. X will be 37,500. That means my opening stock is 37,500 opening. So my closing will become 37,500 plus 5,000. That will be 42,500. Okay, so opening is also found 37,500 and closing will be 42,500. Clear? Okay, so this sum included all the type of almost all the type of important formulas. Okay, now when I will go to the exam questions, we will cover some of the other formulas also which we have not taken yet and solved it. Okay. So let's go to our exam question. Okay. N Limited has a net working capital of 119 lakhs. Total liabilities is 225 lakhs and non-current liabilities is 140 lakhs. The current ratio will be equal to how much? Okay. Now they are asking me my current ratio. So current ratio is equal to current assets upon current liabilities. Right? My working capital, they are telling me, working capital is 119 lakhs. So basically, working capital is nothing but current assets minus current liabilities. Okay, that is coming to 119 lakhs. Now my total liabilities is equal to 225 lakhs. From that, if I remove my non-current liabilities, which is 140 they have given me, therefore my current liabilities will be equal to 85 lakhs. Right, 85 lakhs. So now if I am just working capital plus current liabilities will be equal to current assets. I know my current liabilities. I also know my working capital. So 119 is my working capital. My current liabilities I just found 85. So my current assets will be equal to how much? 204. Okay, total liabilities and non-current liabilities were directly given to me. I found my current liabilities. But with the help of my current liabilities, I can find my current assets. Why? Because working capital is given. Working capital formula is current assets minus current liabilities. I found my current liabilities. Working capital is also there. Therefore, current assets is 204. So this will be 204 divided by 85. Your answer will come as 2.4:1. So this is my answer. Clear? There are many other similar sums like this in the past exam questions. Okay, the ones which were there in 2017, 16. Okay, there are similar this type of questions only. I have taken one of each type. Okay. Second one. A company purchases are 385 lakhs. Sales 510 lakhs and closing stocks 58 lakhs. If the rate of gross profit is 25% on cost, then the stock turnover ratio is how much? Okay, all this is given to me. Cost plus profit is equal to sales. Cost means COGS. Gross profit is equal to sales. I'll need sales amount. No? I need stock turnover ratio to be calculated. Gross profit, they are saying it is 25% on cost. So assume cost to be 100. So sales will be 125. Okay, now 510 is the amount of sales. So if I will cross multiply, okay, I will get my profit. My profit will be how much? Cross multiply 510 into 25 divided by 125. You will get 102 lakhs as your gross profit. Therefore, your cost of goods sold will be equal to 510 minus 102. 408 lakhs. So I have my sales, I have my cost of goods sold also. Okay, now COGS and I also have my purchases. So here, okay. Opening and closing stock I need to find. COGS is equal to opening stock closing stock is given to me, no, 58 lakhs. Okay. So I'll have to find the opening stock also. Opening stock plus purchases minus closing stock. COGS I already found out 408. Opening stock I don't know. I'm assuming it to be X. Purchases is given to me 385 and closing stock is given to me as 58. Therefore, X will be equal to, if you will calculate, it will come to 81 lakhs. So opening stock is 81, closing stock is 58. Therefore, average stock will be equal to 81 opening plus closing upon 2. That will come to 69.5. So I have my average stock. I also have my COGS. I can find my stock turnover ratio. Therefore, stock turnover ratio will be equal to COGS upon average stock or average inventory. COGS is 408 and average stock is 69.5. This will come to 5.87 times. Here the answer is 5.87. Okay. Now moving to the next question. Mahi Limited has a closing stock of 648 lakhs and there are prepaid expenses of rupees 32 lakhs. Total liquid assets were 1830 lakhs. If the liquid ratio is 1.5:1, then the working capital will be how much? Okay. Now they are telling me the liquid ratio, which is liquid assets upon liquid liabilities, is equal to 1.5:1. Fine. Now I know my formula. Liquid ratio is 1.5. Liquid asset is what? We have current assets minus stock minus my prepaid expenses upon my current liabilities. Okay. Now I have to find my current assets first. Current assets will be equal to total liquid assets current assets will now be equal to total of liquid assets plus stock plus prepaid expenses. So 1830 plus stock will be 648 plus prepaid expenses is 32. So my current assets will be 2510. Okay. 2510 will be my current assets. So for working capital, current assets is what I have already found. Okay, now coming back to the liquid ratio, 1.5 is equal to, put current liabilities here. 1.5 of current liabilities. Make the equation. 1.5 of current liabilities will be equal to 2510 minus your stock, which is 648, minus your 32, which is already given 1830. Okay, so current liabilities will be equal to 1830 divided by 1.5. Therefore, current liabilities will be 1220. I have my current assets. I also have my current liabilities. Therefore, working capital will be equal to current assets minus current liabilities, which is 2510 minus 1220, which will be equal to 1290 lakhs. Answer is B, 1290 lakhs. Okay. Now question number 4. From the following are the details of Beta Limited. Equity share capital 1500 lakhs, 8% preference share capital. Then we have 12% debentures, profit before interest and tax, dividend payout ratio 70%, price earning ratio is rupees 25, corporate tax rate is 30%, earning per share will be how much? Okay, so profit before interest and tax is equal to 59. From that, if I will subtract my interest, which is 12% on my debentures. Okay, so 12% on debentures, 250, 30 rupees, 30 lakhs. Okay, so profit before tax will now be equal to 560. So if I less my tax at the rate of 30%, it is 168. So profit after tax will now be equal to 390 minus preference dividend, which is 8% of 400, 32. Your preference capital 400 into 8%. So preference dividend will be 32. Therefore, profit available for the equity shareholders. Available for equity shareholders is 360. Divide that by number of equity shares. Okay, number of equity shares is 360 divided by 150. No, 1500 lakhs divided by 15 rupees share. So 150. Therefore, earning per share is coming to 2.40 per share. Okay. Next is, from the following information, calculate the net profit ratio. Gross profit is 1/4 of the cost and sales is rupees 2 lakhs. Indirect expenses is rupees 12,000. Now cost plus profit is equal to sales. 1/4 means 25%. So 1 divided by 4 percentage. So it is 25% of cost. So sales is equal to 125. Sales amount is given to me as 2 lakhs. Therefore, the gross profit I can find. Gross profit will now be 40,000. Therefore, COGS will be 1,60,000. Sales is 2 lakhs. Okay. From my gross profit, for net profit, from my gross profit, I will subtract my indirect expenses. That is how I will come to my net profit. Now, gross profit is 40,000. 40,000 minus my indirect expenses is 12,000. So that is going to be 28,000. Therefore, my net profit margin will be equal to net profit upon sales into 100. Net profit is 28,000. Sales is rupees 2 lakhs into 100. Your net profit margin is going to come as 14%. Okay, 14%. Answer is C. Now next sum. XYZ Limited books of account shows a profit from operation. EBDIT. Profit before depreciation, interest and taxes 500 lakhs. It has paid 12% on the debt of 1,000. So minus interest, if I do at 12% on 1,000 lakh, it will be 120. Okay, so 500 minus 120, 380 will be earnings before depreciation and tax. If I will subtract my depreciation, which is given to me 100, this will be EBT, earnings before tax 280, minus tax will be equal to, tax is 35%. 280 into 35%, 98. So profit after tax will be equal to 182. 182 lakhs. Easy. Profit after tax only they ask. Question number 7. From the following information pertaining to A Limited, there is a current ratio 4, asset test ratio is 2.8, current liabilities is 31 lakhs. We have to find the value of inventory. Okay, so current ratio, since my current ratio is given to me. Okay. Current ratio is equal to current assets upon current liabilities. Current ratio is how much? 4. Current liabilities is how much? 31 lakhs. Therefore, current assets will be equal to 31 into 4. That will be equal to 124 current assets. You have to find the value of inventory. Liquid ratio. Asset test ratio is also known as liquid ratio. Liquid ratio will be current assets minus stock upon current liabilities. Liquid ratio is given to me as 0.28. 0.28 into current liabilities is 31. Current assets I just found. Stock I can now find. Therefore, stock value, which is, I can assume this to be X. Therefore, stock will be equal to 37.2 lakhs. Easy, no? 37.2 lakhs. Asset test ratio means liquid ratio. Answer is C. Question number 8. From the P Limited has furnished the following information: cost of goods sold, net profit and sales return. Okay. If the net profit margin of P Limited was 25%, then the gross profit margin was how much? Okay, net profit is equal to 3 lakhs. Now, how do I find my net profit margin? Is nothing but net profit upon sales into 100. Right, therefore sales will be equal to net profit upon net profit margin. Net profit is 3 lakhs. Net profit margin is 25%. So 3 lakhs divided by 25%, it will be 12 lakhs. My sales amount. Okay. Now, gross profit margin. Gross profit margin is gross profit upon sales. How will I get my gross profit? Sales minus COGS upon sales into 100. How much is my sales? Sales is 12 lakhs. Sales is equal to 12 lakhs. Minus cost of goods sold is given to me as 6 lakhs. Upon sale. Sales is again 12 lakhs, I know. Into 100. So this is going to be 50%. So here 50% is the answer. Okay. Now next question number 9. The relevant details of the company are given. Equity share capital rupees 25 lakhs. Face value is 100. Profit for equity shareholders is 5 lakh 15. Dividend payout ratio and price earning ratio. Calculate earning per share. You can directly solve this sum. Earning per share is equal to profit for equity shareholders divided by number of equity shares. Profit for equity shareholders is 5,15,000. Number of equity shares here, it will be how much? 2,50,000. 25 lakhs. 25 lakhs divided by 10. No, divided by 100. So it will be 25,000. So 5,15,000 divided by 25,000. You will get 20.6 rupees per share. Answer A. Okay, question number 10. Same thing is there again. Okay. Equity share capital is 25 lakhs, face value 100, profit for equity shareholders 5 lakh 15, dividend payout ratio is 40%, price earning ratio is given. Dividend per share is how much? Okay, so we know our earning per share is equal to 20 point, just we found out 20.6 rupees per share. Okay, dividend payout percentage is given to me 40%. So 20.6 into 40%, 8.24 dividend per share will be equal to 20.6 into 40%, which will be equal to 8.24 per share. Same sum it is, continue, but they are asking dividend per share. From the following information, I am going to the next one. Calculate debtors turnover ratio. Closing debtors is 2 lakhs. Cash sales is 25% of the credit sales. Excess of closing debtors over the opening debtors is 80,000 and total sales is 12 lakhs. Okay, so let credit sales be X. Okay, now they are telling me cash sales is 25% of credit sales. So total sales, if I want to do, it will be equal to cash sales plus credit sales. Cash sales is 25% of X, no? Because I have assumed credit sales to be X. Total sales is 12 lakhs. So 12 lakhs is equal to 0.25x plus X. 12 lakhs. I will divide that by 1.25. 0.25 plus 1 is 1.25. Therefore, X will be equal to 9,60,000. So my credit sales I have found. Now opening debtors is less by 80,000 with the closing debtors. So it will be closing debtors minus 80,000. Okay. Closing debtors is already given to me 2 lakhs. Minus 80,000. Therefore, opening debtors will be 1,20,000. With the help of opening and closing, I can find my average debtors. Average debtors will be opening 1,20,000. Closing is 2 lakhs. Divide by 2. Okay, 1,20,000 plus 2 lakhs. Divide by 2. That will be equal to 1,60,000 average debtors. Okay, now coming to your debtors turnover ratio. Therefore, debtors turnover ratio will be equal to your credit sales upon average debtors. Credit sales is how much we just found out, 9,60,000, and average debtors is 1,60,000. So it will be 6 times debtors turnover ratio. Okay. Next one, using the same information in question number 11, calculate average collection period. So average collection period, I have to just turn my first formula which I just did. It will be average debtors, I already have that, upon my credit sales into whatever they are asking me in average credit sale. Okay, they have not told me months or year. Okay, I'm taking months into 12. You can have to take note 12 or 52 or 365. Okay, average debtors is 1,60,000. Credit sales was 9,60,000. Do that. One lakh 60,000 divided by 9,60,000 into 12. Okay, you are getting 1.999 times. So it will be 2 times approximately. So basically it is 2 months. Alright. So these were the past exam questions. There are many more also. Okay, if you want to go for in the year 15, 16, 17, 16, 17, 18. Okay, there are many more such exam questions. But there is nothing new in it. It is the same time. Okay, so if you want to finish your ratios revision quickly, what you can do is what I have already done with your all the formulas. Okay, all the formulas here. When we started the lecture, I had started with all the formulas: net profit margin ratio, gross profit margin ratio. So I will suggest you all to go as per what I have revised today and finish your this chapter. There are many more sums like that to be solved, and you will be able to solve all the questions from any book which you are referring to. What you need to know, keep this particular sheet in front of you. revise these formulas, understand the concept behind the formulas, go to my practice questions, okay, and with the help of my practice questions, you will be able to solve all the past exam questions, okay. For your all the revision lectures which I have taken until now, all the marathon lectures which I have done for accounts, for FM, okay, there you can download our app, okay, and that there will be free revision notes. You can take the notes from there. However, even in the description, we have put the link for this notes so that it becomes easy for you all to refer to my lecture and revise again if in case you need. Okay. So thank you everyone so much. I again am requesting you, please join our Telegram group. You can get access to these notes, to any kind of other new announcements which we come up for other revision lectures in case. All the other announcements regarding ICSI also will be posted there. So join our Telegram group, join our WhatsApp group, download our app, okay, and stay tuned for any further announcements to be made. Okay, I wish you all the very best. Thank you so much. Bye bye.